Hey, how's it going? Bill Lethman here for Money Evolution. In this video, I'm going to be talking about how you could create $120,000 of retirement income for your retirement. In this video, I'm going to be walking through another hypothetical client situation and walking through the exact strategy and some of the methodology that we use working with our clients one-on-one on a day-to-day basis. And we're also going to show you how you might be able to apply this to your individual retirement situation. But real quick, before I get into the content of today's video, if you're watching this and you'd like to learn more about what we do at Money Evolution, we'll put some links down in the description below, but you can head over to moneyevolution.com. There you can learn about two of our primary financial planning programs that we offer, the Money Evolution Plan and our Retirement Time Machine. We also have some great free resources, and we'll put links to all of that down in the description below. Okay, so let's jump into our hypothetical situation here. Again, we're going to assume that this is a married couple that are 60 years old. They're both exactly the same age. In reality, you may be a little bit older, a little bit younger. You may have more than $2 million of investable assets, or you may have a little bit less than $2 million of investable assets. So this is just for illustrative purposes, but I think you'll find the methodology, some of the strategy that we go through here pretty helpful. So the way that we would typically approach retirement, especially if you're retiring a little bit early, and 60 years old I would say is a little bit on the early side. It's at least before you're even eligible to get Social Security benefits, and it's well before when you're eligible most likely to get your full unreduced Social Security benefits, which is called your full retirement age. And for most people that's probably going to be age 67. So the way we would approach it is to really look at retirement in two parts. What does it look like, and what do you need to fund the early part of your retirement, and then what does it look like once some of that income normalizes? So we're going to make a couple of more additional assumptions here, and we're going to assume that at full retirement age, this married couple has $60,000 of combined Social Security benefits. So what we have, and we look at the situation, is from age 60 to age 67, if they want to take out that $120,000 per year, they're going to have to pull 100% of that from their portfolio assets. We're going to assume also that they don't have a pension. You may have a pension, and you would just kind of subtract that from that amount, and the numbers would still mostly apply here to your situation. But $120,000 a year is going to need to come out of the portfolio for the first 7 years. And if we multiply that out without adding any interest or anything like that, that's going to be about $840,000. Not about, it's going to be exactly $840,000 per year. And then once that full retirement age hits and you're 67 years old, you're going to get the Social Security benefits. You're going to have $60,000 of that Social Security income coming in. So if we subtract that, then your net need after full retirement age is just the $60,000. And again, this is going to be the approach and very similar to what we go through with a lot of our clients. In fact, I would say probably 90 or 95% of the financial plans that we do have something that looks fairly similar to this, where you have some bigger cash flow needs in the early part of your retirement, and then as that full retirement age hits and you've got maybe pensions and Social Security, the need for taking money out of the portfolio tends to go down a little bit. You also may have some higher expenses in the early part of retirement, especially if you're having to, for example, go out into the exchanges and buy health care through the Affordable Care Act. That would typically be a little bit higher than what it would be once Medicare kicks in. You may also have some other things that are going on in the early part of retirement, maybe still paying off a mortgage, still covering some of your kids' expenses or helping them through college and things like that. But anyway, these bigger gaps in the first part of retirement, in the early part of retirement, need to be, in my opinion, accounted for separately. And then what does it look like after that full retirement age hits? So if we wanted to create this $120,000 worth of income, we're going to look first at that first 7 years. And we're going to make a couple of assumptions here. And right now, as we're filming this in late April of 2025, interest rates on CDs and even money markets and things like that are typically around 4%. It might, some bonds might be a little bit higher, some might be a little bit lower, but for practical purposes or illustrative purposes, we're going to just assume that's going to be 4%. So if we sort of map that out and we say we could earn 4% on what we typically refer to as our first two buckets, And for a refresher, those buckets are designed to cover some of those early cash flow needs or some of the next 7 years worth of cash flow needs. So bucket number 1, we would typically have about 2 years of cash flow needs in bucket 1, and then we would have an additional 5 years or so in bucket number 2. So if we got 4% on that money, then instead of needing the full $840,000, if you were able to earn 4% on that and then take that $120,000 each year, you would really just need a little bit more. I'm rounding here a little bit. You would need about $720,000 to cover that first 7 years of your retirement. And then anything over and above that, the rest of the $2 million could go into bucket number 3, which is essentially going to be your growth bucket. And so that's going to be $1,280,000 that is going to be left over out of the $2 million that we have in total portfolio assets after we fund buckets 1 and 2 with that $720,000. We're going to have $1,280,000 left over, and that's going to go into bucket number 3, which is essentially our growth bucket. And this is really pretty much what we do with our clients and how we would set up a bucket strategy approach for dealing with some of the anticipated cash flow withdrawals. Most important part of this whole thing is understanding and knowing what those cash flow withdrawals are, and we've really simplified this into saying, hey, it's going to be a set amount for these first 7 years of retirement, and then it's going to be a set amount for the years after full retirement age through the rest of their lifetime. In reality, there's a lot more moving pieces to this. You know, again, we talked earlier, mortgages being paid off and kids' expenses and healthcare costs. You may be a different age from your spouse, so you may start getting Social Security in 2027, and your wife or spouse may not get it until 2030. And there's going to be a lot of different moving pieces here. What I would generally say, and where we would make this line in terms of the early part of retirement and then where the income and the expenses and everything sort of stabilize, is going to be basically at the age of the younger spouse. Whenever that younger spouse is going to reach their full retirement age and that income really starts to normalize throughout the rest of the plan, that's where we want to draw that line in the sand. Everything up before that, you may have a lot of variability in those actual expenses and want to account for that and add up all of those different expenses and then build out your cash flow buckets appropriately based on those early cash flow needs. You may still have some changes after full retirement age, but generally after full retirement age is where things really start to stabilize there. Okay, so what do we do now? Now that we've set up this bucket strategy, we go into retirement. What do we do on a year-to-year basis? This isn't just a one-time thing. We don't just do this at the beginning of retirement, setting up our buckets and then hope that that growth bucket all works out. No, what we're going to want to do is we're going to continue to want to anticipate some of those cash flow needs and continue to refill buckets number 1 and bucket number 2. And we're going to want to do that as long as the market, as long as our growth bucket is still performing positive. And the idea of the bucket strategy is really to give ourselves a little bit of a buffer. And it is just a little buffer. It's a 7-year buffer. That may seem to some people like a long period of time for markets to recover. I know here in 2025, if we look back to the last several market downturns, they've tended to have some fairly quick recovery times, but that's not usually the norm. If we go back and we look at the great financial crisis in 2008, it took about 5 or 7 years, depending on what you had the money invested in, to see the investments fully recover. It was the same thing after the dot-com bubble burst in 2000. It took 3 years just to get to the bottom, and then it took another 5 years to get to the top. And just as it was getting up to the top, that's when the great financial crisis started. So if you kind of loop all of that together, we really had about a 10 or 12-year period where the markets essentially went sideways with 2 massive declines in there. So we don't want to just let bucket 1 and bucket 2 drain out and then hope that when we start needing some money that the growth bucket is going to be up in value and we don't have to sell anything at a loss. So the idea is that we want to keep buckets 1 and 2 filled up all the time. So if we kind of fast forward and say, okay, well, what is the need after we run out of money or after those bucket number 1, bucket number 2 run out after the 7 years? Well, number 1, we're not going to let them run out, but our long-term need at full retirement age is going to be $60,000 per year. And where we get to that is, again, our need that we're accounting for here is $120,000 per year. We're going to assume that you're going to have that Social Security coming in at $60,000 a year combined benefit. Again, your numbers may be a little bit different, but then our net need at that point is $60,000. So what we're going to want to do is on an annual basis, as long as our equity investments or that growth bucket is up, we're going to want to move $60,000 every year from the growth bucket and refill bucket number 2, and then bucket number 2 is going to continue to refill bucket number 1. So bucket 1 is going to be very short-term money markets, very short-term CDs. Bucket number 2 can be a little bit more, I don't want to say long-term, but maybe a CD ladder, something like that, some 3-year bonds or 5-year bonds even in some cases there, depending on what makes the most sense based on the current interest rate environment and everything. But we're going to want to continue to refill bucket 1 and bucket 2 with about $60,000 a year to keep that topped off. And then again, the idea is if the markets are flat or the markets go down, then we're going to maybe let bucket 1 and bucket 2 drift down, and hopefully it doesn't get to zero before the market has a recovery. So this is the strategy, but of course there are some uncertainties. There's a lot of things that we just don't know going forward and trying to project what's going to happen over retirement that could be 20 years or 30 years or longer here. So some of those things we don't know. We don't know what kind of return we're going to be able to earn on bucket number 1 and bucket number 2. Interest rates are fairly high right now today in 2025, at least compared to what they were about 4 or 5 years ago, and really for the better part of the previous decade where interest rates were only in the 1 or 2% range. So of course, the more interest you can earn on bucket number 1 and bucket number 2 means you can put less money in there. Like we were looking at there, $720,000 covers about $840,000 of withdrawals if you were able to lock those rates in and carry that through the 7 years. But as you reinvest and you take that $60,000 to refill bucket 1 and bucket number 2, you don't know what kind of return you're going to get on there. The bigger issue is probably going to be, what does that growth bucket do, and what kind of return does that growth bucket need to make? And if we do go through a market downturn, how long does that market downturn last? We just don't know. If we look back through long history, there's been some sideways markets where the markets have gone for 10 or even 15 years, where basically they ended at about the same place that they started 15 years earlier. So a lot of this is going to come into play there as you go into retirement. So what we're going to look at here is we're going to look at what is the rate of return that you need to have or get with that growth bucket to still be able to replenish the buckets and still have a good chance that money is going to last you for the rest of your life. So to maintain this 4% rule as we go into the later stages of retirement, after your full retirement age begins, we know we need $60,000 per year. So if we just simply divide that by 0.04, we can come up with a number that we essentially need to have in the portfolio at age 67 when we change and we shift gears from needing $120,000 per year to come out of the portfolio to needing $60,000 per year. So we know we have $1,280,000 in the portfolio when we started this whole thing. So really all we need to do is we need to grow the portfolio from $1,280,000 to $1,500,000. And that really only comes out to be about a 2.6% compounded rate of return over that period of time. So it's not a huge benchmark to beat, but it's certainly not guaranteed as well either. Again, if we go through a sideways market and that $1,280,000 just simply, maintains itself over that first 7 years, well, then that's going to cause our withdrawal rate going forward to be something higher than 4%. And the question is sometimes a 5% withdrawal rate can work. Even a 6% withdrawal rate could work. But when we start getting above 4% as a withdrawal rate, the probability of that starts to go down fairly significantly. For example, if it gets up to 6%, there's really only about a 15% chance that the portfolio is going to last for a retirement of 20 years or longer. So I think when we do this, if we were to see a flat return over this period of time, and the first 7 years that is, we would end up at about a 4.6% withdrawal rate on the portfolio. So just a little bit higher than 4%, but it's changing our odds just a little bit in a negative way against us. If we were to see a market downturn and we were to see even a 5 or a 10% decline over 7 years, and you may think that may not be realistic, but that's happened many, many times throughout the market history where we've seen a 7-year period where markets were less. In fact, if we go through what some people refer to as the lost decade, and we start at the year 2000 at the top of the dot-com bubble, we go through the bottom and the recovery of the dot-com into the great financial crisis. By 2009, which was about a year after the aftermath of the great financial crisis, the S&P 500 was actually down about 9% over a 10-year period. So not only did it not make any money, but it actually went backwards a lot. So if you know anybody that's retired in that time period around 2000 or 2008 and experienced any part of that market sideways and downturns and everything like that, that was a very challenging time for people to be able to maintain their retirement lifestyle with those massive market declines. So this is just to kind of point out and say this is how the strategy works, and make you aware that there's risks with it. And so as you're putting this together, you really want to think about not only what income is coming in, but what those expenses look like, and then even maybe get into a little bit more detail on those expenses and say, here's our expenses, but then maybe separate out what are the core expenses that you have, what are the things that you absolutely need to pay, your food and your groceries, your basic transportation, housing costs, things like that, and then what are some of those extras. So if you've budgeted an extra $20,000 a year for travel and vacations, that's fantastic, but know what those differences are. What are those discretionary expenses, so that if we do go through these market downturns or sideways periods, then you know how much money you really need to cover your basic core expenses, and then how much of that is extra that you could maybe skip a year of some of those vacations and things. And I know nobody likes to hear that, but as we're talking about this, it's really important to understand so that you can have that money last you for the rest of your life, and you don't find out when you're running out of money until it's much later in life. So it's going to be down the road. It's going to be when you're 80 or 85 years old, and all of a sudden you're going to be in a position possibly where that money is down or hasn't moved in the upward direction that you planned for, and now it's putting you into a jeopardy situation where that money could possibly run out. Okay, so what do we do? What are some things that we could do to try to improve our odds here a little bit? Well, one of the things I've talked about in several other videos is looking at ways or strategies that you could add more predictable income to your portfolio so that you don't have to take as much out of the portfolio, or at least you have something in the portfolio that's going to produce some more regular streams of income here. Some things that you can look at here, things like dividend paying stocks would be one thing that's very popular. Dividend stocks are going to be a little bit tricky though, however, because it's going to require you to sort of section off a part of your portfolio, and depending on what kinds of dividend stocks you buy, you're not going to really get a lot of yield from that. You might only get 2% or 3%, maybe even 4% from the dividends, and that may not be enough to kind of cover enough of that $60,000 gap long term. And so what could end up happening with that is that it requires you to take a larger distribution from some of the money that's in that growth bucket that's not part of the dividend strategy, and that may be difficult to sustain and maintain over a long period of time. For other people, and some people have done this throughout their entire lifetimes, but adding things like rental income producing real estate as a way to take part of your portfolio assets and put it in something that's going to generate some income on a regular basis. Another idea and strategy we've been talking to a lot of clients about is using an annuity for a part of that predictable income stream. And again, as we film this in late 2025 or late April 2025, incomes on annuities are very good right now. So for example, a 60-year-old couple that wanted to get joint income from an annuity would be able to get 6% guaranteed withdrawal for the rest of their life on whatever they put into that annuity. So again, right there, we're already kind of beating the 4% rule by really 50%, 6% instead of only 4%. So by taking a part of the portfolio and putting it in something that's going to generate a bigger guaranteed portion of that predictable income, it could take pressure off of the other parts of the portfolio. Additionally, many of these annuities, and the one that I'm kind of referring to here in a hypothetical situation, is they also tend to have annual increases. So if you decided that you didn't want or didn't need to take that income right away, they would generally give you some method of increasing that withdrawal rate to some future date. And in this case, right here, it might be, let's say, 0.5%. So every year you delay would get another 0.5%. So if you waited 1 year, instead of 6% withdrawal, you would get 6.5% withdrawal. So again, what we did here in this hypothetical example, funding those first 7 years with that $720,000, we've basically covered the first 7 years. So if we were to wait 7 years to turn on the income from this annuity, instead of getting 6%, we would actually get 9.5%. So again, and that's going to be basically when this couple is 67 years old, and even if they lived 20 years to age 87 or maybe 95, they lived another 8 years past that, this income would be guaranteed for the rest of their lifetime, no matter what. So if we said, okay, well, we have $1,280,000 left over that's part of that growth bucket that we talked about there after we funded the $720,000, if we wanted to cover the $60,000 gap that we're going to have at age 67, how much money would we have to put into an annuity to cover 100% of that? Well, we could do the math backwards, divide that by 0.095, and that's going to come up with about $631,000 that would go into the annuity. So this is giving you some predictable future income that is contractually obligated in this situation to pay out that $60,000 if you were to defer taking income for that 7 years. So basically, about half of your growth bucket could be something that could generate 100% of that future cash flow gap that you're going to have at age 67. And now we've just changed, we flipped the switch, the script here a little bit. Instead of having to worry about and think about what the market may do, are we going into a good sequence or a bad sequence or a sideways sequence, whatever that may be, now we've got more of that predictable income. In fact, according to this, again, we got inflation and taxes and things like that to think about, but we've got 100% of that $120,000 covered through two very secure income sources, one being the guaranteed withdrawal from the annuity, and the other one being the Social Security benefits that are going to be coming in. So if you think about the way you operated for 30 or 40 years during your entire work history. You saved money probably on a regular basis very diligently. You were having money withdrawn from your paycheck to go into a 401k plan, and you were constantly buying the investments that you held inside those accounts. And the markets went up and the markets went down, and they kind of rolled on through time. But two things make it different, very much different than what it looks like in retirement. One of those is that you're a long-term investor. And when you're 25 or 35 years old, you still have decades ahead of you to let the market's ups and downs work out. And if we go back over 100 years of history, the market averages look very, very good over long periods of time. It's when we kind of zoom in and we look at some of those individual market periods where we see some of those bad markets. But bad markets do exist, and really good markets do exist. But over time, the average is going to be pretty good. So you are a long-term investor. And then as you get closer to retirement, then maybe that shifts a little bit where you start to take a little bit of risk off the table. At least that's what most people should do. Take a little bit of risk off the table and move into some more conservative things, because now your time horizon is shorter, and now not only are you not going to be adding money to those portfolios, but you're going to be withdrawing money from those portfolios. Because if you think about it, when the markets were down and you were still adding money to your 401k plan, you were buying more shares of those investments at cheaper prices. And so really, it was to your benefit almost to have the market be down and to have it be down for longer periods of time, because you were able to accumulate those positions at lower costs. And then eventually, hopefully the market and those investments went back up in value there. So you shifted that. You flipped the script from basically being a long-term investor, and then to basically now having to be a little bit of a short-term investor. Well, this annuity kind of flips it back, and now you can say, because I have that $60,000 coming in, and it's a guaranteed part of my predictable income. Now with the $631,000 or so, or 600, whatever the half of that is, another $600,000 that's still in that growth bucket, now that can just kind of grow, and you can be a little bit more long-term with that, but you have another moving piece here that, as inflation maybe goes up, or maybe that growth bucket, that $600,000 that's left in the growth bucket has done really well, and you want to just take a little bit out. Maybe you want to buy a new car, you want to take some travel, you take your whole family on a vacation, or you want to maybe start gifting some money to either charities or to your family, and do some of that while you're alive. You have that ability to do that. So anyway, just a couple things to think about there, but really setting up the bucket approach is really the main strategy that I think everybody, as you get closer to retirement, you should be thinking about starting to fill up those buckets. And because we want to have about 7 years of buffer in here, if you're 7 years or less away from retirement, that's really the time to start filling those buckets up, not waiting until retirement and then saying, okay, now I have to fill up those buckets, because when you retire, the market's down 10% or 20%, that's not going to be really very good to be able to do that. It might end up having you extend your retirement out a little bit to hopefully wait for the market to recover. So if you really want to retire at that time that you are forecasting, you want to be building up those buckets a little bit in advance. Anyway, that's it for this video. I hope that made sense. I hope you got a lot out of the video. If you like what we're doing here on the YouTube channel, please hit that subscribe button and check out some of our other videos here. Again, if you want to learn more about what we do at Money Evolution, you can click on some of the links down in the description below. Check out our financial planning programs. We've also got some great resources that we created as well. One of those is something we created called the Retirement Launchpad. It's a completely free set of worksheets to help you start to get organized, put together some budgets, and really organize some of the details that you need for retirement. And we also have our Ultimate Retirement Planning Checklist, which is multiple pages, but it basically goes through every single thing that you should be thinking about and going through systematically and checking off in the years before your retirement and in the early part of retirement, so that nothing is left unturned and there's no surprises as you go into retirement. So we'll have links to both of those down in the description below. So check that out, and I look forward to seeing you back in one of our future videos. Thanks.